We are taking a fire hose of fresh sources analyses, clinical data, financial disclosures, and really distilling them down to the essential insights you need to know right now. Today, we're zoning in on one company, SLS Life Sciences, or SLS, and we're doing that because the bullish argument around it is, frankly, deafening. Our sources are claiming this stock, which is sitting around $4.04, to be precise, is headed for a $7 price target.
That's a potential 73% upside.
A huge upside. And the timeline for this hinges on news that is, maybe only weeks away. So this is a pretty urgent deep dive into a very high-stakes situation.
It really is. And for you listening, this deep dive is going to answer three absolutely critical questions. First, we have to understand the valuation. I mean, how do analysts even get from $4 to $7? Second, we've got to dissect the one single clinical catalyst, this phase 3 trial, that makes this whole thing work. And then finally, we'll look at how the company has sort of strategically dealt with the biggest financial risks that usually plague these small biotech plays.
A financial safety net.
Exactly. That's the roadmap to really understanding this opportunity.
Okay, so let's start with the money. A $3 difference on a $4 stock is gigantic. We see the current price, $4.04. We see analysts like the Maxim Group publicly sticking to that $7 buy rating. So if they think it's worth $7, why is it trading at $4? Why does Wall Street see such a massive valuation gap?
This is where we need to go beyond just saying it's undervalued. We have to look at the mechanics of biotech valuation.
Okay.
In this sector, the stock price really reflects the probability of success. That $4 price tag doesn't mean failure, but it absolutely reflects uncertainty. The market is basically saying, we think this trial has maybe a 50 to 60% chance of succeeding.
So it's pricing in the risk?
It's pricing in the risk. Now, the analysts, on the other hand, they're not just picking $7 out of thin air. They're using a method, it's called discounted cash flow, or DCF, and it's based on one huge assumption, which is successful phase 3 data and eventually regulatory approval. The $7 target comes from projecting the drug's potential peak sales, how much money it could make every year if it's approved for acute myeloid leukemia, or AML.
Okay, so the $7 isn't what it's worth today. It's the value if the trial is a success and the drug actually makes it to market.
Precisely. It's the fully de-risked valuation. If this upcoming data readout is positive, the market immediately starts closing that gap between the uncertainty price of $4 and the success price of $7.
Because the risk just evaporates.
It evaporates overnight. The probability of future cash flow just skyrockets from maybe 50% to, say, 90%. So the key takeaway here is that you are, in essence, trading on the outcome of a single binary event.
Right. It's a yes or no.
It's a yes or no. And that's why the potential returns are so aggressive, but it also explains the risk.
That brings us perfectly to the engine of this whole thing. We've established this prediction hinges completely on one piece of news. And that is the phase 3 Regal trial. Let's dig into this because this is the make or break moment for SLS.
Absolutely. The Regal trial is testing their drug against AML, which is a very, very difficult to treat blood cancer. The urgency here comes from how the trial is designed. It doesn't just end on a specific date.
Right. It ends when they hit a specific data point. And that point is what our sources call 80 events.
Exactly. And, this is where we should probably just pause for a second. While we're talking about stock potential, we have to acknowledge the human side of this. An event in this trial, tragically, means a patient has passed away.
It's a stark reality of this kind of research.
It is. It's the necessary statistical measurement these trials rely on to see if a drug provides an overall survival benefit. So the analysis report is tracking this number like a countdown clock.
And what we learn from the sources is just how close that countdown is to hitting 0.
This is what makes it so timely. So Q1 2026. As of late December 2025, the trial had reached 72 events.
72. So they only need 8 more.
Just 8 more to trigger the final data analysis and what's called the unblinding. Given the rate of progression you'd expect in a trial this size, needing only 8 more events confirms that final data is imminent. We're talking weeks, maybe a couple of months, from the biggest news in the company's history.
But here's where it gets really interesting for me, because the CEO isn't just, sitting silently and waiting.
No, he's not.
The research we looked at highlighted a very specific comment from management.
They did. The CEO stated publicly that the blinded data, and that's data where they can see the combined results, but they don't know who got the drug and who got the placebo.
Okay.
That data suggests survival times are longer than expected.
Now, I have to be the skeptic here for a second. Isn't a CEO interpreting blinded data? Isn't that inherently biased? What checks and balances did the analysts even reference to trust a hint like that? It sounds a little too good to be true.
That's a really fair challenge. And look, analysts aren't relying on the CEO's optimism alone. But they recognize that phrase as a powerful, kind of established shorthand in the biotech world.
It's code.
It's code. The company is under strict regulatory scrutiny. They can't just make false claims. So if a CEO is willing to use language like longer than expected survival, it's a strong signal that the independent data monitoring committee, the unbiased third party, isn't seeing any safety red flags.
Ah, okay.
And it suggests the overall trends look promising enough for him to risk saying that specific phrase. It's like an unofficial nod. Wall Street put a $7 price tag on a positive outcome, and the CEO is essentially signaling with a heavy wink that the internal numbers seem to be pointing that way.
Okay, that makes sense. So that makes the scientific risk feel a bit more manageable, or at least, understandable. But if we connect this to the bigger picture of small biotechs, the single biggest non-scientific risk is always financial.
Always.
They get close to a huge catalyst, they run out of cash, and bam, they have to dilute the stock with a massive offering that just crushes the price right before the good news.
Did the report say if SLS managed to remove that fear?
That is always the critical barrier, especially with an event this big. A successful trial is frankly worthless if the company can't afford the next steps, like preparing their application for the FDA.
Right.
The analysis reports confirm that SLS took a huge defensive step in late 2025 that basically secured their future.
And what was that crucial financial move?
They brought in over $50 million through something called warrant exercises. And this is a really critical distinction from a traditional offering where they're just issuing brand new shares and it can signal desperation.
So wait, what exactly is a warrant exercise then? Warrants are basically long-term options that the company issued, maybe years earlier. They let certain investors buy shares at a preset price. So as the stock price rises and the trial gets closer to finishing, those investors exercise their warrants.
So they're choosing to buy in.
They're choosing to buy in, they pay the agreed-upon price, and the company gets this immediate, non-dilutive, and really substantial cash infusion.
So instead of begging the market for new money, you're saying existing, sophisticated shareholders voluntarily pumped in $50 million because they believe in what's coming.
That's exactly it. It's a clean, confidence-boosting injection of cash. That $50 million dramatically extends their cash runway,
Right.
meaning they have enough capital to fund their operations, and more importantly, all that expensive regulatory work well past these data readouts. By securing this cash before the results, they've taken the immediate threat of dilution off the table. It's a necessary safety net. It lets you, the investor, focus purely on the Regal trial, not the company's bank account.
That is a massive de-risking move. It makes this whole thing feel much more focused on the science. Okay, let's switch gears and look at how the market itself, the traders, the institutional money, how they're reacting to this.
The recent chart pattern is fascinating. It really tells a story of accumulation. Just before the research we looked at was published, the stock saw this dramatic morning drop all the way down to $3.63.
Which could have been a panic signal.
It could have been. But the rally was immediate and aggressive. It bounced all the way back up to $4.15 before settling the day at $4.04.
So what does a sharp drop and that kind of instant recovery actually mean in this context?
It creates what technical analysts call a long wick on the bottom of the daily trading candle. And the significance is huge. When a stock drops like that and then immediately recovers to close much higher, that long tail, it indicates tremendous, powerful underlying buying demand.
Someone stepped in.
Someone stepped in and just wiped out all the selling pressure almost instantly. It's essentially smart money saying, we will take every single share you're selling below $4, thank you very much.
So they're using the dips to load up.
The sophisticated buyers are using those temporary dips, which are often triggered by smaller investors panicking or just taking a bit of profit, as their chance to aggressively accumulate shares before that Q1 2026 data drop. It suggests the market itself is already getting in position for positive news.
Okay, so let's bring this all together. The bull case for a 73% upside to $7 seems to stand on three really solid interlocking pillars. Pillar 1, the valuation gap. It's not arbitrary. It's the gap between today's uncertainty price and the success price of $7.
Pillar 2, the catalyst. The Phase 3 Regal trial is at this crucial inflection point. 72 out of 80 events are done. This all but guarantees a Q1 2026 readout, and it's backed up by those CEO hints about longer than expected survival.
And Pillar 3, the financial safety net. The specter of dilution has been pretty much taken off the table by that late 2025 $50 million cash injection. That secures their runway.
The research we reviewed firmly puts SLS on the top watch list for Q1 2026. It's all driven by this one catalyst. The central dilemma for you, the listener, is that classic biotech risk-reward balance. You have this massive 73% potential upside, but, well, until those last 8 events are in and the data is unblinded, success is never 100%.
But if we lean on that technical buying we saw, the secured cash and the CEO's hints,
Then the final provocative thought to leave you with, and this comes from the report's most ambitious suggestion. If that blinded data holds true and the Regal trial delivers overwhelmingly positive results, could that highly specific $7 analyst target, could it truly be, as our sources suggested, just the starting line for this stock?
Now that is a question worth thinking about.
That's the question, waiting for an answer, possibly in just the next few weeks, something to mull over.
Indeed. We've covered the valuation, the catalyst, the financials, and the market sentiment. Thanks for joining us.